Hi everyone, welcome to Trove of Knowledge. Today we are going to discuss about open market operation, that is second part of monetary policy of RBI. Let's move on the topic. What is open market operations? Open market operation is nothing but that is buying and selling of government securities in the open market. Simply you can say open market operations means buying and selling of government securities in the open market. The purchase and sale is entrusted to the central bank on behalf of government. When RBI buys a government security bond, government bond or security in the open market, it pays for it by giving a check. That is very important statement. That is when Reserve Bank of India buys a government security means Reserve Bank of India giving money to the market. That means this check increases the total amount of reserves in the economy and thus increases the money supply. Oh, that is why we can say when Reserve Bank of India wants to increase the money supply in the market, then Reserve Bank of India buys government security. And the selling of bonds by Reserve Bank of India. There is another process, that is Reserve Bank of India selling government bonds. Selling government bonds means that leads to the reduction in the quantity of reserve and hence the money supply. That means when Reserve Bank of India wants to decrease the money supply in the market, then Reserve Bank of India sells the government bonds. That means then when Reserve Bank of India sells the bond, that is money from the market coming to Reserve Bank of India. That is absorption of money. And when Reserve Bank of India buys a government security, that means injection of money. That is increases the money supply in the market. That is when Reserve Bank of India buys government bonds, then increases the money supply. When Reserve Bank of India sells the bond, that decreases the money supply. These are the important points you have to remember. Once more, I repeat, when Reserve Bank of India buy government bond, that increases money supply. When Reserve Bank of India sells the government bond, that decreases the money supply. So here we can write Reserve Bank of India buys, that is buys government bond. Reserve Bank of India buys government bond, that it means buys government bond. That here you can write here simply market government bond. That means money injecting to the market. That is money injecting to the market. Next thing, Reserve Bank of India sells. Okay, sell government's bond market. Then what will happen? That means money, that is Reserve Bank of India by selling government bonds. By selling government bonds, the Reserve Bank of India taking money from the market. Then what will happen? Here money supply will increases. Here money supply will decreases. Understood? That is Reserve Bank of India buying bonds from the market, then it pay back money to the market. That means money supply in the market will increases. When Reserve Bank of India sell government security, then Reserve Bank of India sell government security in the market, then Reserve Bank of India, then market or individuals or commercial bank pay back to Reserve Bank of India. That means Reserve Bank of India taking money to Reserve Bank of India taking money from the market. That's why money supply in the market reduces. So simply we can say open market operation is a buying and selling of bonds issued by the government in the open market. When Reserve Bank of India wants to decrease the money supply, what they will do, that means they will sell the securities. When Reserve Bank of India increase the money supply, what they will do, then Reserve Bank of India buy the government security. Okay, this is a very simple explanation for open market operations. And here the open market operation is classified into two, that is outright and repo. Let's move on that topic. What is outright operations? Outright operation market operations are permanent in nature. When central bank buy the securities, that means when central bank buy the security, that means injecting money into the system. Here you have to understand, once more repeat, when Reserve Bank of India buys the security, normally you can connect with your day-to-day life. When you are buying anything, you have to pay back. The same way, when Reserve Bank of India buying security, that means Reserve Bank of India pays back. Okay, and that is why here injecting money into the market. And in the outright operation, when Reserve Bank of India buying security and giving money to the market, and here there is no promise to sell them later. That is, there is no promise to sell this security the securities later. Okay, and similarly when central bank sells the securities, the next operation is that when Reserve Bank of India sell the security, here there is no promise, there is without any promise to buy them later. That means there is no agreement of purchase to sell or to buy them later, buy the securities later. That is why this operation is called outright operation. In the outright operation, there is no promise of date and price. And as a result, the injection and absorption of money is of permanent nature. That is outright operation. The next is the repo. Let's move on that. What is repo? There is another type of operation in which when the central bank buys the security. In the case of repo, central bank buys the security. This agreement of purchase, and also there is some agreement of purchase. And the agreement of purchase has specification about date and price of resale of the security. That is, here in the case of repo, Reserve Bank of India or central bank buys the security, and also there is agreement of purchase, and in the agreement of purchase also has specification about date and price of the resale of this security. This type of agreement is called repurchase agreement or repo. And also you have to understand what is repo rate. The rate at which the money is lent in this way, that is the rate at which Reserve Bank of India is giving money to commercial bank or giving loans to commercial bank is called repo rate. That is, money is moving to commercial bank. The repo rate also decides the liquidity rate in the banking system. Here in this figure you can understand very easily. Here Reserve Bank of India, here commercial bank. Here one thing you have to understand, when commercial banks want funds from Reserve Bank of India, then that means Reserve Bank of India is giving loans to commercial bank. The rate at which Reserve Bank of India giving loans to commercial bank is called repo rate. That is, money is moving to commercial bank. That is why the figure is shown like that, liquidity at repo rate. That is, money is moving to commercial bank. And in the case of repo rate, already we said that repo rate means the lending rate. That is the rate at which commercial bank is taking loans from Reserve Bank of India. Or you can say the rate at which Reserve Bank of India giving loans to commercial bank. And one thing here you have to understand, that is, here the definition it is saying that central bank buys the security. That means when Reserve Bank of India giving money to commercial bank, then for that some security is needed. That is why Reserve Bank of India buys government security. Reserve Bank of India buys government securities from commercial bank. That is, when repo rate is charged. When repo rate is charged, some collateral is involved. That you have to understand. When repo rate is charged, then there is some collateral is involved. That is why in this figure shown like that, government securities with the repurchase agreement. That is, in the case of repo rate, there are two things are happening. That is, money moving to commercial bank at the rate repo rate, and at the same time the government securities moving to Reserve Bank of India. That in other words you can say that is Reserve Bank of India buying government security. Reserve Bank of India buying government security, and here it is written like that, government securities with the repurchase agreement. In that repurchase agreement there is some specification about the date and price of resale of this security. That is, resale of this security. That is why this is called repurchase agreement. Okay, here we can use 2-3 definitions. Like, one thing is that when repo rate means, what is repo rate? Simply you can say repo rate means the rate at which money is lent to commercial bank. That is called repo rate. What is repo? Repo means when central bank buys government security. When central bank buys government security, that means when central bank buys government security means central bank giving money to commercial bank. Okay, and the rate at which central bank giving money to commercial bank is called repo rate. For taking money from Reserve Bank of India, commercial bank have to pay some collateral. That is like government securities. That is why it is shown like that. Government securities with the repurchase agreement is moving to Reserve Bank of India. That is why this agreement is called repurchase agreement. Repurchase agreement. Just you can connect this with bank rate. In the case of bank rate, there is no collateral. When commercial bank wants fund from Reserve Bank of India, they can take money from Reserve Bank of India at a rate. The rate at which commercial bank is taking money from Reserve Bank of India is called bank rate. And in the case of bank rate, there is no collateral is involved. But in the case of repo, there is a commercial bank is taking money from Reserve Bank of India, and also there is some collateral. That is, there is some collateral is evolved when repo rate is charged. That is why here, that is why the definition like that, central bank buys the government security. That is, government buys the government security. At the same time, central bank giving money to commercial bank. The rate at which central bank giving money to commercial bank is called repo rate. Next is that repo. Already we are saying this is one of the important monetary policy tools of Reserve Bank of India. The repo rate also decides the liquidity rate in the banking system. Next, we have to understand what will happen to the liquidity rate in the market, in the economy when repo rate increase, when the repo rate increases or when repo rate decreases. Here we can write repo rate increases. Repo rate increases means what happened? That is the actually it is the interest rate for giving loans to commercial bank. That is called repo rate. When repo rate increases mean that discourages commercial bank to take loans from Reserve Bank of India. That means repo rate increases means that discourage commercial bank to take loans from Reserve Bank of India. Why? Because they have to pay much more amount to Reserve Bank of India for taking loan. That is, interest rate is very much high. You can compare this with our life situation. If you want to take loans from commercial bank, when interest rate is very much high, you discouraged to take loans from commercial bank. The same thing happened here. When repo rate is very much high, that discourages commercial bank to take loans from Reserve Bank of India. Then funds in commercial bank, that means commercial bank funds decreases. Then there will be, that means the funds decreases means the funds is using for giving loans. Then fund decreases means the borrowers will be very less. That means money supply in the market will reduce. Money supply in the market will reduce. That is, liquidity will reduce. That is, repo rate is very much high. Then commercial bank funds will reduce. Why? That means that discourage, when repo rate is very much high means the commercial bank discourage to take loans from Reserve Bank of India. What is the output? Then commercial bank funds decreases, then money supply in the economy will decrease. So repo rate is increase, money supply will decrease. When repo rate is decreases, repo rate decreases means we can compare with our situation. If you want to take a loan from commercial bank, the interest rate is very much less. Then that encourage the people to take a loan. The same way, when repo rate is very less or decreases, that encourage commercial bank to take loans from Reserve Bank of India. Then commercial bank funds increases means there is more funds for giving loans to The people, that is, there are more borrowers, they are spending in the economy. That means money supply in the economy will increase. Simply, so that is why we can say when repo rate is less or decreases, then money supply increases. Repo rate is increases, then money supply decreases. Okay, that is why we can say repo rate also decides the liquidity rate in the banking system. Okay, next, what is reverse repo rate? Similarly, instead of outright sale of securities, the central bank may sell the security. Here, central bank may sell the security. In the case of repo, there is central bank buys the security. Here, central bank sell the security through an agreement. There is some agreement which has specification about the date and price at which it will be repurchased. This type of agreement is called reverse repurchase agreement, the opposite operation. In this case, the Reserve Bank of India is selling government security. Okay. Look at here. Here, Reserve Bank of India selling, that is government securities with repurchase agreement moving to commercial bank. And commercial bank giving money to Reserve Bank of India. That is why it is written like that, liquidity at reverse repo rate. That is why what is reverse repo rate? The rate at which the money is withdrawn in this manner is called reverse repo rate. Here, Reserve Bank of India withdrawn money from commercial bank. Reserve Bank of India withdraw money from commercial bank, or you can say Reserve Bank of India selling government securities, Here one thing you have to understand, for easy understanding of this concept, when commercial bank having excess funds, they can park their funds in Reserve Bank of India. When commercial bank having excess fund, they can park their funds in Reserve Bank of India. That is why here that is why it is shown like that, money or liquidity is moving to, cash is moving to Reserve Bank of India. For that some collateral is needed. That is why Reserve Bank of India, for taking money from commercial bank, that is Reserve Bank of India taking money from or withdrawing money from commercial bank, for that Reserve Bank of India giving or selling government securities to commercial bank with some repurchase agreement. In repurchase agreement has specification about date and price of these securities. Okay. Here Reserve Bank of India taking money from commercial bank. The rate at which Reserve Bank of India withdrawing money from commercial bank is called reverse repo rate. And in the figure it is shown like that. That is government securities moving to commercial bank. But here money liquidity is moving to Reserve Bank of India. That is in the case of commercial banks are having excess funds, then they can park their excess funds in Reserve Bank of India. The rate at which commercial bank deposit funds in Reserve Bank of India is called reverse repo rate, or you can say the Reserve Bank of India is withdrawn money at rate. Withdrawn money at rate is called reverse repo rate. Okay. Then you have to understand what happens when reverse repo rate increases, reverse repo rate decreases. Reverse repo rate. Here, look at here, reverse repo rate increases. Reverse repo rate increases means commercial bank will get more interest from Reserve Bank of India. That means that encourage commercial banks to park their excess funds in Reserve Bank of India. Okay, that means that encourage when repo rate is increases. When reverse repo rate is increases means that encourage. That means commercial bank will get more interest rate from Reserve Bank of India. When reverse repo rate is increases, that encourage commercial banks to park their funds in Reserve Bank of India. So more funds moving to Reserve Bank of India rather than giving loans. Then what will happen? The funds in commercial bank funds will decrease. Commercial bank funds decrease. Money supply in the market, that means there will be more borrowers, then money supply will decrease. When next case, reverse repo rate decrease. Reverse repo rate decreases, then what will happen? That discourage commercial banks to keep their funds with RBI. That means there will be what? That means reversal. That is in the state from Reserve Bank of India is very much less. That is why commercial banks discourage to keep their funds with the RBI. Then commercial banks funds increase. Then there will be more funds for giving loans. That means more borrowers. That means more money supply in the market. That is why simply you can say when reverse repo rate increases, money supply decreases. Reverse repo rate decreases, money supply increases. Okay, once more I repeat. Reverse repo rate increase, money supply decreases. Reverse repo rate decreases, money supply increases. In the case of reverse repo, that means Reserve Bank of India is selling the securities through an agreement. Here you can understand that. That means commercial banks depositing funds to Reserve Bank of India. For that, Reserve Bank of India is giving securities to commercial bank. That is why we are saying like that Reserve Bank of India selling government securities with a repurchase agreement. In repurchase agreement, there is some specification about date and price at which it will be repurchased. Okay, that is why this agreement is called reverse repurchase agreement or reverse repo. Okay, I hope everyone has understood this concept. The Reserve Bank of India conducts repo and reverse repo operations at various maturities. There are some maturity period, that is overnight, 7-day or 14-day. Okay, these are the maturity periods of repo and reverse repo operations. This type of operation have now become the main tool of monetary policy of the Reserve Bank of India. This is very important, and you have to understand there are some maturity period, that is overnight, 7-day, 14-day for repo and reverse repo operations. And also in the two video, actually we conducted two videos, that is monetary policy 1 and 2. In the first video we discussed the CRR and bank rate, and here in the case of CRR increases, the money supply will decrease. When the bank rate increases, money supply will decrease. Repo rate increases, then money supply will decrease. Reverse repo rate increases, then money supply will decrease. This is very important. You have to write in your notebook. Then CRR decreases, bank rate decreases, repo rate decreases, reverse repo rate decreases, then money supply will increases. Okay, this is by using these tools, Reserve Bank of India can control liquidity in the market. When liquidity is very much high, then Reserve Bank of India decreases money supply by increasing these ratios like CRR or bank rate or repo rate or reverse repo rate. When money supply liquidity is very much less, when money supply wants to increase, the money supply wants to increase, then Reserve Bank of India will decreases these measures, that is CRR, bank rate, repo rate and reverse repo rate. Once more I repeat, that the CRR increases, then money supply will decreases, bank rate increases, then money supply will decreases, repo rate increases, then money supply will decreases, reverse repo rate increases, then money supply will decreases. Then CRR decreases or bank rate decreases, repo rate decreases, reverse repo decreases, then all the cases money supply will increases. These are the important points regarding repo open market operations. Open market operations simply buying and selling of government security. That is simply you can write buying and selling. Okay, this is when buying government security. When government security, buying means injection of money. This is very important. Injection of money. Selling means absorption of money. This is very, very important for absorption of money. These are the important points. Okay, buying and selling. And next is what is repo and what is reverse repo. Repo and next is reverse repo. Reverse repo rate operations. Okay, these are the important point in open market operations. I hope everyone has understood this concept. And in the next video, I would like to do reference between repo rate and bank rate. Thank you all. Thank you for watching.